Valens Research, Uniform Financial Analytics.
Regeneron just recently, I believe it's Sanofi, decided that they're going to sell off their 20% ownership in Regeneron. And so an obvious question for investors might be, hey, does that make sense? And you would look at what Sanofi is doing, and you'd say, well, Sanofi sees a company that has $600 stock price, right, and sees a company that has, right, $20 earnings. So Sanofi sees a company that has almost a 30 times PE using as reported earnings, and not just a 30 times PE, by the way, right? When we're looking at the EPS, the orange distorted EPS number for Regeneron, right, it declined from $23 to $20 last year, from 2018 to 2019. So Sanofi looks at this and sees a company that says, hey, it's trading at, call it 27 times, and it's got declining earnings. Yeah, this might be a good time to sell that, to be able to actually reinvest that business into things, like they said, things like specifically the opportunity to invest in cancer, et cetera. But when we look at the uniform accounting numbers, what we see is it's not a company that has declining returns and also has, $20 earnings on a $570 stock price. We see a company, right, as I highlighted, with a PE, with an earnings number that's actually around 40 times, right? That's a 40 times $40 EPS on $570 of stock price, meaning we're seeing a PE that's only at 13 times. Market expectations for Regeneron, where Sanofi is selling, are very, very, very low, not very high. And that's really interesting because that also is highlighted in these white bars here. What the market is pricing Regeneron to do right now is have returns collapse from 20% to 6% with continued 15% reinvestment. Let's actually just say the market thinks that Regeneron isn't going to have burger again. What the market's basically saying is Regeneron, that's grown massively every single year for the last 10 years and has had relatively stable high returns, is going to have no growth at all, and returns get cut by about a third. Or if you expect growth to continue, returns to be cut by basically 3/4. This is an incredibly low valuation that Sanofi may be selling this business at. And that's what's so interesting, because you can have that kind of conversation. You can say, hey, if my company that I'm looking at acquires this company, does it make sense? Are they buying a cheap asset or expensive asset when I think of it relative to peers? And also the exact same question that we're going to have in terms of going forward when a company is divesting a company, are they making the right capital decisions? And we can see here for Regeneron is on an as reported basis, looking at as reported EPS and as reported ROA trends, you would get why Sanofi is running, right? Because you would say, well, yeah, of course, that makes perfect sense. This is a company that is having declining returns and is at a premium valuation of potentially as high as 27 times. It's only when we see through the noise and we see what this company is really doing that we can understand that this company actually is higher return and lower PE than Sanofi may realize. And the other interesting thing is actually, let's look at Sanofi really quickly. And if we look at Sanofi really quickly, what we can see is, well, Regeneron is trading at a 13 times multiple, what's Sanofi trading at, right? Sanofi is trading at slightly higher multiples, a 15 times multiple. So what Sanofi is doing is they're selling a business that is higher return than Sanofi is, right? Sanofi is a 15% return. Regeneron is a 24% return. And Sanofi is selling a business at a lower PE than it actually has, meaning it's going to be in aggregate more expensive after the sale because of the fact that it's spinning off an asset the market's paying a discount for. And these are the kind of insights, again, the kind of conversation that we can have because we're looking at the uniform accounting number and not the distorted as reported metrics.
Valens Research, the world's leading source for uniform financial analytics.